Good evening, everyone. Welcome to our UC Riverside Alumni Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. We really appreciate you taking time out of your busy schedules to join us for tonight's Wednesday class on our home buying workshop platform. I know we have a lot of interest in signups for tonight's class, so we're going to allow everybody to join our Zoom session. You saw our note earlier that we generally start these classes just at the top of the hour, but we'll allow all of our signups since this was widely received to be able to join our class. Tonight's class is being recorded. So we will have tonight's class up on our YouTube channel tomorrow. In fact, all of our presentation material that I'm sharing with you this evening will be sent out to you via email because you've signed up for tonight's class. And we also make this a very interactive session. So our runtime for tonight will take us up to just about the top of the hour, but we will be weaving in some of your questions that the audience has. We'd encourage you to either use the Q&A function within Zoom, or you can certainly drop your question in the chat as well. And myself and my colleague Ken will get those questions answered on air. We'll also carve out a little bit of time at the end of tonight's class to answer any follow-up questions that you have. Again, we really appreciate you taking the time out of your busy schedules, especially on a Wednesday night, to learn a little bit more about home ownership. We're really proud to be in partnership with UC Riverside Alumni. We've been in partnership for well over 5 years, and it's really an opportunity for us to help really educate our local community on home ownership. In tonight's class, we have a variety of different topics that we're going to spend some time diving into. But again, we would encourage your feedback as we go through tonight's presentation. A little bit about me and our organization. So I work with a company called American Pacific Mortgage. We're a California-based direct lender. Myself, I've been in the industry for well over 20 years, and I teach classes just like this all across the country to help inform our communities about what first-time homeownership might look like. And you're going to learn a little bit more about our process a little bit later after tonight's class to really learn about more about if you're deciding to take those next steps in homeownership, what it might look like for you. Well, as we kind of dive into tonight's class, I want to share with you some of our talking points for this evening. We're going to spend some time looking at the housing market, what's going on with inventory levels, also talk a little bit about interest rates and how that can impact your buying power as a prospective homeowner. We're going to talk a little bit about budgeting for home ownership and what does it look like if I was to compare renting versus owning, if I was to do like a side-by-side comparison. We'll also look at credit, how to prepare ourselves from a credit perspective, learn a little bit more about what credit models look like in the mortgage lending space and how to optimize credit score. Talk a little bit about loan programs that can support you on this path towards homeownership. And then we'll transition into looking at savings plans. How do we prepare for homeownership to properly save for things like down payment and closing costs on my path towards homeownership? We'll also spend some time looking at first-time homebuyer programs. I think most of our class is probably in California. So we're going to spend a lot of our class time looking, or not a lot, but a segment of our class time looking at first-time buyer programs that are available to you. I also want to walk you through the home buying process. So after tonight's class, you may say, hey, I want to learn a little bit more about designing my own home buying plan. We're going to walk you through to go from coursework here in tonight's class to what does it look like to take the next steps in home ownership. And we'll also talk a little bit through about different milestones that you'll experience as a potential home buyer. And what does it look like to do a consultation with us and how do we take those next steps? All right. So that's kind of what our plan is for tonight's class. Again, we'd encourage you to use that Q&A or chat function within Zoom. We'll get those questions answered for you on air. All right. So the first thing we got to think about with home ownership is, does it really make sense for me to pursue home ownership? I hear a lot of things out there as I'm talking to friends and family and coworkers about home ownership, but truly, is it right for me? So when we think about home ownership, we got to think, does it make sense for me in my current financial situation? Because when we think about home ownership, there's a lot of great benefits that comes along with it. You can create potentially better affordability for yourself. No longer do I have to worry about maybe a landlord that keeps on ratcheting up rents on me every year. So I can really control my budget a little bit more when it comes to home ownership. And, clients that are choosing to purchase in today's rate climate, this isn't probably going to be the forever loan for them, because if I can get into home ownership at this entry point today, there'll probably be an opportunity for to refinance my loan for a lower payment, lower interest at some point down the road. Now, in purchasing a home, this is an asset, right? So this is an asset that potentially can grow over time. So this is a big major financial decision that you're making, and that asset that once you acquire it can hopefully grow over time. As we look at the value of our home as it appreciates over time, when we compare that versus what is owed on a mortgage, the difference in the value of my current home versus what's owed is called home equity. And for most of us across the country, it's probably the largest asset that we have. That asset is the opportunity really to create generational wealth for our families as well, too. Now, there's also some really great tax benefits that come along with owning a home. So you could potentially deduct interest on your mortgage. And there's also potential upgrade or energy efficient upgrade opportunities that come along with home ownership. So as we consult with clients all across the country on home ownership and figure out if home ownership is right for them, I encourage them to think more about those benefits that come along with owning, because truly ownership versus renting is not necessarily what I would say is an apples to apples comparison. Because think about it, from a rental perspective, we're paying rents on a monthly basis. That landlord is gathering those rental income benefits. But you as a tenant don't realize the same benefits that your landlord realizes, right? And so as we consider home ownership, it's really important to kind of put in perspective what that might look like for us. And I think a great place to start is to kind of spend some time looking at budgeting. So what we're going to do now is talk a little bit about renting versus buying and how does that stack up when we compare the two. So I'm going to kind of change our screen here. We're going to look at a budgeting calculator that we have here in case you missed it, because I know we have some of our attendees that are just jumping into class right now. All of the presentation material we're going to send back out to you guys via email tomorrow. So we have your email on file because you obviously enrolled for tonight's class. We'll get you all the presentation material out tomorrow. So here's what this rent versus buying calculator looks like. We're going to take in consideration, we kind of put a what if example on screen here for you, but essentially is looking at if I continue to go down the path of renting today, what does that look like for the next, say, 7 years? How does that look like if I decide to own in the next 7 years? So in our scenario here, we have a prospective buyer that's currently spending $2,750 in rent. They have renter's insurance at roughly $15 a month. And then we're expecting or projecting that rent to increase 3% on an annualized basis. Okay, so that's kind of our baseline for the rental situation. And then from an ownership perspective, let's assume that we're going to purchase, let's say, a $650,000 place. You're going to learn a little bit more about minimum down payments and loan programs in just a few minutes. But ultimately, when you utilize a conventional loan program to purchase at $650,000, the minimum down payment is 3%. Okay, so we're going to build that into our model here. We also make an assumption around property taxes for our home, which generally most lenders will evaluate property taxes for qualifying at 1.25%, give or take, of the purchase price. We have homeowners insurance, which will be part of our expenses of our home. And then we have maintenance costs for the house, right? So that would be on the expense side of owning our home. And then we also want to plug in loan information. So when we think about our loan, generally for most first-time buyers, we're going to elect a 30-year fixed mortgage product. Let me get back to our screen here. We just kind of jumped a little bit. We're going to elect a 30-year fixed mortgage product. We're going to talk a little bit about interest rates in just a few minutes, but we're going to plug in average interest rate 6.5%. We have origination charges, which essentially is what your lender will charge you for your financing. Now, beyond our workshops that we provide to the UC Riverside Alumni Association, we also discount our services in working with our APM team. We actually take our origination costs down by $750 just to add extra affordability for our prospective buyers. That's either on a home purchase or on a refinance. And then we have discount points. Essentially what discount points are is the ability as a consumer to pay additional funds out of pocket that will essentially lower your interest rate. Usually one discount point is the equivalent of about 0.25% reduction in your interest rate for your mortgage. Now, in today's market where we're already at elevated levels, I don't really recommend buyers paying discount points because the break-even point on discount points is usually like 3 to 4 years. And most buyers buying today are probably going to refinance in a couple of years. So it doesn't really make a lot of sense to make those investments today. It's interesting. I was talking to a client that's in the Southern California market earlier today, and that person was getting quoted just a ridiculously low rate. But when we kind of peeled the situation back a little bit, we discovered that the client was actually paying this enormous amount of points in order to bring down that interest rate. So the optics on that rate looks really great, lower payment and whatnot, but that client has to put additional funds out of pocket to bring that interest rate down. So not necessarily something we'd recommend in today's market. Then we have other settlement services. Those are things like title, escrow fees, some of the county fees for the transfer of ownership. So that all gets baked into the category of what we call as closing costs to buy our house. We would say that closing costs and what we call as prepaid items for your home purchase will generally be somewhere in the 2 to 3% estimated range of your purchase price. We'll spend some more talking about that a little bit later in tonight's class. And then finally, we have some other assumptions that we're going to make in our calculator, which is, how much is my home going to appreciate over time? Which we put 4%, which is pretty realistic number. We put 7 years that we'll be in this home, the average selling cost of about 10% of my purchase price, state and federal tax rates, and then finally the savings rate. So for our scenario here, we're comparing, renting at roughly $2,700 a month versus buying at $650 in price. So from a payment perspective, we're looking at a pretty big difference in payment, right? So we're paying $2,700 in month today. In rent, it's going to go to about $5,400 from an ownership perspective. So big climb up. However, when we kind of factor in the cost opportunities, including home equity appreciation, potential tax benefits of my home, I have about a $63,000 upside opportunity of owning that home versus renting over the next 7 years. And that's what we would encourage buyers to kind of think through a little bit. Now, we have to certainly make sure that monthly budget is within line for our affordability, but at the same time, buying in today's market or over the next year or two could still reap some really great benefits for our first-time buyers. So I would encourage you, when you have some time and you get the presentation material tomorrow, try to dive into that calculator. I think that exercise is super useful for our prospective buyers in considering home ownership and, of course, all the benefits that come along with owning a home. All right, we're gonna dive back in now and talk a little bit about the housing market. I get a lot of questions about this throughout the country, like, Jason, what's going on with the housing market? What's the projections? What are we seeing happening so far? Well, if we're kind of just looking at where we're at in 2025 right now, we just started. I think the first day of spring was last week or something. So we're in most parts of the country, things are starting to warm up a little bit. Generally speaking, that will bring more sellers to put more homes on market, which we can certainly use. And we do have a bit of an inventory challenge in most parts of the country where we just don't have a lot of supply to support the demand of buyers. And believe it or not, there is a lot of demand out there, even though we're at kind of elevated interest rate levels today. If we were to look at Riverside housing market, and since we're doing this for our UC Riverside partnership, we're going to spotlight Riverside, which, this shows you just the outlook of Riverside. At the same time, some of the numbers, or the trends, I should say, look very similar to other parts of California. So if we look at, median sales price right now, $650 in Riverside County, you can see kind of a little up and down over the last 3 years, but it's pretty level, right? I think when we look at the Riverside County market in particular, obviously we see a lot of buyers that are moving out maybe from LA County to maybe reap a little bit more of an affordable market per se. But, as we see inventory challenges probably remain over the course of 2025, the buyer demand will probably push prices up a little bit, is our guess, especially if interest rates start to tail down a little bit, which we'll talk about interest rates in just a bit. But if interest rates go lower, it generally will pick up buyer demand. If buyer demand picks up, inventory level doesn't change, then we will probably see some increase in prices out there. Now, builders are trying to keep up with inventory as well. They're trying to build new homes, especially when you look at Riverside, San Bernardino County, seeing some some of those markets that are really probably fueled a little bit more by new home sales, can help support inventory. But I still think we're going to have some challenges to remain in the markets. If you're in LA County, if you're in Orange County, San Diego County, Ventura, these trends look very similar. Limited inventory, pretty high demand. Obviously, the price points of those markets will look a little bit differently just because of overall cost of living. But as we kind of project out into the remaining months of 2025, I think we're still going to see some of those same challenges. But as we look at April, May, June, July, and August to a certain extent, those are traditionally the busier times of the home buying years. Even with kind of the state of kind of what we're seeing in the economy right now, the overall kind of geopolitical environment. So there still remains high demand out there, but not a lot of inventory necessarily to support that buyer demand. As I mentioned, interest rates will influence buyer behaviors. We still are at elevated levels today, although we're about 2.5 to 3 month lows in interest rates. Obviously, many of us are probably paying attention to what's going on economically. I think it's important to know that as prospective buyers, generally, when we see bad economic news, that's usually good news for interest rates. So over the last couple of weeks, the talks around tariffs have put some pressure on the stock market. We've seen the Dow take some pretty big hits last week, over the last couple of weeks. We don't like that from a 401k perspective, right? So for most of us that have 401ks, we probably saw some decreased balances there. At the same time, that negative news or the impact of the Dow Jones positively generally impacts interest rates. And so that's kind of what we're going through. It's a little bit of a seesaw right now in current interest rates. I do think we're probably going to remain at elevated levels and of interest rates throughout 2025, but I think we are going to see interest rates start to tick down. It's not an if type of situation, it's a when. And I just want to give you some context on why we're here from an interest rate perspective. We're all kind of there's some challenges from just a cost perspective, right? Inflation is quite high still. The Federal Reserve has inflationary goals of 2%, as well as a strong labor markets. And in order to combat inflation, the Federal Reserve has ratcheted up the federal funds rate. Now, we have seen some recent cuts in the federal funds rate, but it remains to be seen based upon economic data, how much more the Federal Reserve will cut rates or how quickly the Federal Reserve will cut rates. In the March meeting, no rates were cut. Rates were left static. We'll see at future meetings if we do see some rate cuts. But as you hear in the news that the federal funds rate is being cut, won't necessarily equate to a mortgage interest rate reduction, but it will have ripple effects into mortgage interest rates. Last thing I want to touch on here from an interest rates perspective, obviously you can see kind of the blue line representing the 30-year fixed mortgage, kind of a little bit of a choppy market. September was our best months of interest rates in the last 12 months, but we've certainly elevated since then. Hopefully we'll kind of return back to those days fairly soon. Tomorrow we do have gross domestic product numbers coming out, so we'll be watching that really carefully because that can influence interest rates up or down tomorrow. And then last thing I want to touch on here is just where have we been in the last 20 years? Because I think that's important for a perspective on interest rates. It's interesting. Today's rate levels almost mirror what we saw 20 years ago. Of course, cost of housing looked a lot different, but we're back to where we were 20 years ago. I think, to have some perspective too on interest rates recently, because some of us maybe just only have a recent frame of reference of when interest rates were at 2.5% and 3% during the pandemic. The question I get often is, well, are we going to return to those levels of interest rates? Hopefully the answer is no, because obviously if something, so there's something that would trigger us to going back to those levels, like some type of global issue that we have again. So we certainly don't want to return there. But I think historically we'll see interest rates in the low 5% level, but economic news, good or bad, will drive those levels of interest rates. So that's what we're kind of seeing right now from an interest rate perspective. I think it's important to understand that as consumers, that when you elect to take on home ownership, your interest rate can look a little bit different for each of us, right? It depends on what our credit score and eligibility for our product looks like, the program ultimately that I'm going to select for home ownership, how much I decide to finance for my home loan. Even the amount of down payment can also influence my interest rate. We talked a little bit earlier about discount points, and if I elect to pay more funds out of pocket, how that can influence my interest rate. And then the term of my loan can also influence interest rates. So if I go from a traditional 30-year fixed mortgage down to maybe a 20-year or maybe a 15-year fixed product, that can decrease my potential interest rate. I'm going to get a chance to meet with you, hopefully for a one-on-one to design a home buying plan for you and figure out the right product for you and set some financial goals for you for home ownership. So at that time, we'll kind of figure out what the right setup is for your financing. But as a consumer, I think it's important to know that it's not just a one size fits all when it comes to mortgage interest rates. Right. One of the bigger influence items in interest rates is credit. So we always like in our classes throughout the country to talk a little bit about credit, just to kind of put a little bit more visibility on credit. And I know many of us in class have some type of monitoring system that we're checking out, what activity levels look like on our credit. But in credit scoring, there are three different agencies. There's Equifax, Experian, and TransUnion. Each one of those agencies have different models. Now, in mortgage financing, we're always going to look at the mortgage model, but there's three different separate models. There's the credit card model, which, by the way, is used for most of your monitoring services. There's the auto financing model. So when I run out and go buy a car, and then there's the mortgage model, right? And so, of course, on the mortgage side, that's what we're going to look at in qualifying. Now, every loan program has a minimum credit score. We've kind of spotlighted some of those programs, of which most of those you're going to learn about tonight in class, but they do have minimum credit score requirements. When we look at credit in general, we're going to look at some of the factors that are influence your credit score. If you've had some maybe past challenges on your credit report, maybe it's some late payments or maybe it's a bankruptcy or something, some event that's triggering maybe a decrease in credit score, we're going to help you kind of talk through those. Generally, events on my credit score that are kind of high impact items are going to impact you within 1 to 2 years from the date of the event. Now, as you move further away from that event, you should start to see some improvement in your credit score. In a minute, we're going to talk a little bit about credit utilization, which tends to be kind of the biggest area of opportunity for most clients I work with. We're going to talk a little bit about account closure. And then just as a side note, each agency is going to report a score, as you're probably even aware of. But in lending, we always look at the middle credit score for all clients that apply with us. So for example, if I'm at a 740 as my top score, let's say my middle score is 720 and my lowest score is 700. In qualifying, I'm going to look at the 720 credit score for my eligibility for product, rate, even mortgage insurance. Now, if I'm going to apply with my partner, but let's say my partner is at 700, 680, and 660, well, the lowest middle score between the two of us is 680. So that's what would be used from a qualifying perspective. So as we meet with clients, we're going to kind of strategically figure out like what's the right design of the application. Should we apply together? Should maybe only one of us apply? If that's important to hopefully optimize or maximize, I should say, buying power and kind of the overall setup of your financing. This matrix on screen here kind of shows you how long past challenges will remain with you on your credit report. Generally, most items like late payments will be with you for 7 years, but from the date of the event, like I said earlier, 1 to 2 years from that event, it's kind of more where it's going to really impact your credit score. Let's dive in and talk a little bent about the credit weighting when it comes to the mortgage model for scoring, because I think this is where there's an opportunity for most of our clients. So I want to kind of walk you through this and kind of explain each area. The first area is the length of credit. So essentially, the longer my credit profile has been open, the better my potential score could be. So if I just opened up credit, say 2 years ago, that score might be a little bit lower than maybe a consumer that has had credit for the last 10 years, right? And the number of accounts can have an influence on that. So I want to have longstanding accounts that show maturity, and I want to avoid opening up new accounts because new accounts, it has basically about a 20% of the weighting in the credit score model. So I want to avoid like opening up a lot of accounts, especially in the most recent 3 to 6 months. I want to, maybe open up one here, one there, but I really want to avoid opening multiple accounts in a short period of time. So the model is looking at not only that, but am I trying to get new credit inquiries? Am I applying for things in the form of hard inquiries? Hard inquiries can have a negative impact to your score, especially in the most recent 6 to 12 months from the inquiries. Now, in our process with American Pacific Mortgage, we only start with a soft inquiry. Here's the reason why we do that, because most of our first-time buyers, it will take some time before you're ready for home ownership. So we want to provide and educate you on your options without impacting your score. So we always start with a soft inquiry, which is quite a bit different than most lenders. That soft inquiry gives us visibility to your score without impacting the score. Now, there are scoring rules in place for mortgage and auto financing inquiries, which states that you have a 30-day window of time to shop around with many lenders as you want, and it's the equivalent of one credit inquiry to your score. Okay. But like I said, in our process, we like to do the soft inquiry because it just limits that time constraint that some buyers might have. Next thing is amount owed, which is essentially looking at revolving credit, comparing your credit balances versus your credit limits. All right. So if I have a credit limit of $10,000 and my balances are at $5,000, as a percentage, I'm at 50% utilization of that credit limit. Now, the optimal level to get to, what I would encourage a client to do is get to 10% utilization. So in that example, I would want to be at $1,000 in balances or less. Now, if you're, say, running at 80 or 90% utilization, you're probably seeing some pullback in your credit score. My first kind of benchmark of improvement, I would say, is try to get to 50% utilization. Once we've gotten there and we've gotten good control of our revolving accounts, then I would work towards 30% utilization. And then, like I said, 10% utilization or less is really the optimal levels. Now, let me give you a quick tip to take away from tonight's class on credit when you manage credit card debt. On your credit cards, there's a billing cycle or statement date. That date is the date that all your activity closes out for the prior 30 days. It's also the date at which the credit card issuer sends out your account information to the 3 credit agencies. So my tip for you tonight is, if you can, try to pay down that balance or pay it off, hopefully, before the end of that cycle date, because when you do that, that's going to get a much lower balance reported out to the agencies, which in turn lowers utilization and hopefully helps lift that credit score higher for you. Okay. Last component, which is the most important, is payment history on the credit score model. So it's 35% of the overall weighting for credit score. If we're looking at late payments, they're categorized as 30-day lates, 60-day lates, and then 90+ day delinquencies. The more severe on that day of delinquencies, the bigger impact I'm going to have to my credit score. Again, looking at the last 12 to 24 months is the most impact to my credit score. For example, I was meeting with a client earlier today, had a late payment in October of last year. That late payment was a pretty significant late payment. It really damaged their credit score. And most often, there's really no resolution to credit score unless you're able to negotiate for a removal of that late payment. So that client is probably going to see the effects of that late payment for the next 12 to 24 months. So just something to really kind of keep in mind as you're managing your credit score. Now, as we meet with you for an upcoming consultation, we dive into credit as well, because there's always some opportunities for every client that I meet with. Whether you're at a 760 credit score and trying to figure out to get to 800 score, or maybe you're at a 660 score and really want to see how you can crack through into maybe a 700 credit score level. All right. Now, on credit scores, we also see student loans appear, right? And for those of us that do have federal student loan debt, most payments are on kind of a forbearance right now because of pending litigation over student loan forgiveness. So hopefully we'll have some resolution on that in 2025, but it can impact eligibility from a financing perspective. So I like to bring that up in our classes, because with those types of accounts, even though I'm in forbearance and not actively making payments, we still have to count a minimum payment for our clients in qualifying. So for example, if I'm applying for a conventional loan and I have $75,000 worth of student loan debt, by default, as a lender, I have to use 1% of those total balances as the monthly payment, which of course would be $750 a month. Now, if I'm applying for an FHA loan, then I use half of that amount, essentially $375 per month. Now, most of us that do have federal student loan debt and have had a previously in place income-based repayment, that generally can be used if I'm actively making payments with the income-based repayment. But if I'm on forbearance, by default, the lending guidelines today requires to use either that 1% or 0.5%. So pretty important to have that. And we're going to walk you through that when we meet with you for your consultation. But ultimately, those are kind of the guideline rules when it comes to student loans. If you're in like public employee forgiveness program that usually is 10 years, at the end of 10 years when that debt is forgiven, then it's completely wiped from your credit file. Of course, we don't account that in the debt qualification until we do see that forgiveness. Deferments, if I'm back in school because I'm working on my master's program or whatnot, that also pauses your student loan payments. But if you're going to apply for home financing today, then we still have to factor those into the qualifying. All right. I'm going to take a quick pause there to answer any questions because I know I've covered a lot of ground here so far for our class. Any questions so far on some of our topics that we've reviewed to this point? And again, you can use the chat feature or the Q&A if you want, if you do have any questions, and we'll tackle your question for you tonight. Feel free to drop those in. All right, I don't see anything yet. So I'll tell you what, let's go ahead and talk about our next area, which is essentially loan programs and some of the features and benefits of each one of those loan programs. Now, a lot of what we just talked about in student loans are the output of the guidelines for each of these programs that you're going to look at. So they obviously have varying characteristics. And so let's kind of dive into these. Some of these you've already heard about, but it's important, I think, to provide a little bit more context around each one of these products. The first one is a conventional loan. That's a Fannie Mae and Freddie Mac loan. You may have heard about those, especially during the housing crisis of 2008. The conventional loan program has a minimum down payment of 3%. Up to a loan amount of $806,500. So if you're buying in Riverside or San Bernardino County, that will be the maximum loan amount. Now, let's say you're in LA County. Well, that loan amount goes all the way up to $1.2 million based upon the differences in cost of living. However, when we go above the conforming limit of $806,500, that minimum down payment jumps from 3% to 5%. Right now, the minimum credit score for a conventional loan is 620. As you're going to learn a little bit later on in tonight's class, when we put less than 20% down, there's a thing called private mortgage insurance, or PMI. So we're going to have an exercise on that in just a bit. The next product is the FHA loan. FHA stands for the Federal Housing Administration. This is a government-insured loan. It has a minimum credit score of 580 with a minimum down payment of 3.5%. Now, the maximum loan amount for the FHA product varies by the county that you're going to buy in, and you can see our county. I believe this is for Riverside and San Bernardino County. On screen, it's $763,600. But again, you go to different parts of the state or country, you're going to see different maximum loan amounts there with FHA. The jumbo product is our next product, which is not typical for most first-time buyers, but allows for 10 to 15% down, or has a minimum down payment of 10 to 15%. Minimum credit score of 700. And there's a little bit higher asset requirements with the jumbo loan. Not only do I have to save up for down payment and closing costs, but there is a thing called reserves with jumbo loans, which essentially is I have to have on hand about another 12 months of my monthly payments in addition to savings for down payment and closing costs. So if I have a $7,000 mortgage payment, I need another $84,000 in assets. So jumbo is going to come into play when we have to finance a client that stretches beyond maybe the guidance of maybe Fannie Mae or Freddie Mac loan products. I did see your question in the Q&A, so I'm going to answer that in just a second. But let me touch on the last two products. First one is the VA home loan product. That's for our veterans that have eligibility under the VA home loan. It's a zero down payment option, allows a lot more flexibility for qualifying for our veterans. When we look at things like expenses versus income, gives a lot more flexibility to encourage home ownership for our veterans. There really is no maximum loan amount set in the guidelines for the VA home loan. With that product, it's going to allow us to be able to couple the product with, say, first-time buyer programs as well, too. By the way, the first-time buyer programs that we're going to talk a little bit about in tonight's class can be complemented with both conventional FHA, VA, and USDA products. And that brings us to the USDA product. The USDA product is for clients that want to buy in more rural areas. So let's say you're going to buy in Joshua Tree, for example. Then that has a zero down payment option out in that market. Minimum credit score of 620 up to a loan amount of 806,500. It is going to be for rural areas, so the qualifiers include the geography, but also the household income is also factored into that as well. All right, so that's kind of a look at some of the loan programs. We're next going to talk a little bit about mortgage insurance. Before I do that, let me just take a couple questions that came in from the audience, which is the first one is, are there certain areas that will become more expensive in the future that really aren't as expensive right now, relatively speaking, like Riverside, San Bernardino, Bakersfield? I think, especially in today's market, everybody's kind of going from high cost of living markets, moving, in this case, let's say east, to try to find relief for housing costs. Ultimately, as we talked about supply and demand essentially tonight, right? So as demand pushes out to those areas, there's going to have to be more building that happens, or, more homes that come on the market to support those buyers, because it could actually drive up the cost of homes. And we've already seen that, over the last 3, 4, 5 years, clients that I helped in Riverside and San Bernardino County, the price point has jumped dramatically in those markets. So yeah, there will be probably a natural increase in some of those markets. Another question we had is, how do we know which loan to choose? Also, do certain cities have other first-time buyer programs that can help on top of these loans? So you've heard me mention consultations a couple times tonight. So as I meet with you for your one-on-one session, which by the way is like a 30-minute video session, we're going to figure out which program matches best to your financial goals and objectives and overall qualifying. So we're going to help kind of give you all the tools and resources around that. And as it relates to localized community programs for first-time buyer programs, when we get to our first-time buyer segment of tonight's class, I'll kind of dive into a few other ideas around that too. All right, let's talk a little bit about mortgage insurance now. So that comes up a lot in our conversations with clients. So we're going to explain what PMI looks like for you as a prospective buyer. Now, PMI stands for private mortgage insurance. And then there's MIP, or mortgage insurance premium, for government insured FHA loans. And so let's first of all look at the conventional loan. The conventional loan requires mortgage insurance when we put less than 20% down to purchase my home. Now, that mortgage insurance is scaled based upon how much I put down, what my credit score looks like, and how much I decide to finance. Okay, so that's what that looks like. Now, PMI on a conventional loan, one of the benefits is it does have a cancellation option that once I reach generally 2 years in that loan and I have 20 to 22% equity, I can apply to have the mortgage insurance canceled. Okay, so that's one of the big benefits with the conventional loan. Now, some of us in class have maybe already jumped on Redfin or Zillow or whatever site to do like some searches on homes. You may have even been intrigued to learn a little bit more about what the payment might look like for a prospective house. What I've found in working with clients in local markets is that a lot of those calculators have skewed mortgage insurance premiums that tend to be a lot higher than what they really actually are, because they're not really kind of like, they're not calibrated essentially to the factors that we see on our slide here. So if I was to look at, say, financing $450,000 and I had a credit score of 740 and maybe my down payment was the minimum of 3%, my mortgage insurance is probably around $138 a month. Okay, so probably a lot less than what you think it might be. So and so that would be something we look at. Now, if I move my score to 760 or 780, maybe even 800, that mortgage insurance might even decrease a little bit. Now, on the other side of our slide, we have the FHA loan product, the Federal Housing Administration loan. It is a government insured loan, which has two components to mortgage insurance. It has monthly mortgage insurance, which is calculated at 0.55% of my total loan amount. It also has upfront mortgage insurance, which is 1.75% of my loan amount. That gets added into my financing. So it is upfront a little bit more expensive than the conventional loan when we compare the two products. Also, something to note on the FHA product, it does not have a cancellation option like conventional loans do. So usually with the FHA product, from my perspective, it's really going to be the temporary solution of entry point to homeownership for a lot of buyers, because as things change financially for a client, I would really want to encourage that client to move from FHA to a conventional loan at some point through refinancing. So if we look at the cost of an FHA MIP scenario, we finance the same, let's say $450,000. My upfront mortgage insurance that gets added into my loan amount is $78.75, plus I have monthly mortgage insurance at $206 a month. Okay, so as we cross compare these programs, I know we had the question about, how do I know which product works for me? As we get a chance to meet with you, we're going to figure out what the right approach is for products, because not all clients will qualify, let's say, in the conventional product. And so FHA can be another option for our clients. FHA is going to have a little more leniency when it comes to qualifying, especially credit score wise, or maybe challenges I've had on my credit. And so, FHA can be another great support or resource for us in that path towards homeownership. But those are conversations that we'll have with our clients as we're kind of building their home buying plan and figuring out some of those goals. Okay, I think Ken's taking that question. Okay, so let's talk a little bit about qualifying income. And, those are one of the things that, we have in conversations with clients. First of all, understanding what income can be used to help me qualify for my home. Now, we all have a set housing budget per se, but ultimately, when we think about qualifying income, we're looking at what income can us as lenders use to make sure that there's enough income to support the expenses of the household. Now, we do have to document what that income looks like, and generally we're going to have a list of items like W-2s for the last couple of years, most recent 30 to 60 days of pay stubs that we'll ask for. And in some cases, we'll also ask for tax returns as well, too. Especially if I'm self-employed, we do have to validate the business for the last 2 years. All right. Now, one of the questions we get often when we look at income is what income, or do I have maybe a timeline that I have to be on my job in order to qualify for a mortgage? So there's a 2-year rule in place for financing, which essentially means that I need to show a 2-year history of employment and or supporting education. So one of the examples I give in some of our classes is the scenario of, let's say I graduated from Riverside in the fall, right? I just started my job January 1st, and I have obviously less than 2 years on my job, but I can use my 4-year degree from UC Riverside to support my history to be able to make up that 2-year requirement. In fact, I just have to show that 2-year employment and or educational history. Like if I'm also going to think about transferring to a different job or starting a new job, I don't necessarily have to be on that job a set amount of time in order to qualify for a mortgage. Now, where it changes a little bit from a 2-year perspective is that if I have, let's say, dual employment, like I work at 2 locations for maybe a medical facility, if I want to include both of my sources of income, then I'm going to want to show that I've been on both jobs for the last 2 years. Okay. All right. So we had a question in the chat, and I think we also had some self-promotion here. So we appreciate that too. But looks like we had somebody put some information in the chat. So, but the question I did have come in was, can we receive? Okay. Okay, perfect. Okay. So sorry, I misread a chat message, but these assistance programs, I think there's more question about that. So Ken, thanks for helping me out with that as well. But these assistance programs they are going to be more kind of across the country. So depending on what market you're in, we can support you with different first-time buyer programs. So most of our class tonight is going to be in the California markets, but if you're in a different part of the country, let's say you're in Texas, for example, well, Texas has first-time home buyers that can help support you. So, so sorry for misreading that chat message. I just want to make sure that we had the right information for our class. All right. Last thing I wanted to touch on income before we move along is to talk a little bit about other sources of income. Like, for example, let's say I have a partner that's contributing income to my household, and that partner is not going to be on my application. So in that case, unless I want to introduce that income source, I can't use it unless that person is going to be a part of my application. And then let me touch on really quick on self-employment history, because that's pretty important too. I do, like I mentioned earlier, have to be on my job at least 2 years or have my business for at least 2 years in order to count that income. So it has to be 2 years of tax filings. An example that comes up often for our clients is that, let's say I'm working a 40-hour work week job, but I also have side work that I do for, let's say, Uber or Lyft or something like that. If I do want to introduce the Uber and Lyft income or DoorDash income, whatever the case may be, I have to show that I've been on both my 40-hour work week job for 2 years and been doing the supplemental job for an additional 2 years. All right. Okay, and I have a question that related to income that came in the Q&A. So let me just answer that for the group. Do you have to report all your income? For example, what if I'm employed but I also have a side business, or I'm just starting a side business that doesn't generate a lot of income? So great question. It just depends on how you're reporting the tax income right now. So if it's a new startup, but you have let's say your standard W-2 income right now, it depends on what cycle you are within the tax filing period. So if it's something I just started, for example, in 2025, obviously I haven't self-reported it yet, but you'll have to make the decision on how you're going to report that to the IRS. We will talk about Dream for All in a little bit. I know that came in the Q&A, so we'll talk about that during our CalHFA segment. And then another question is, does the supplemental income have to be a 40-hour 40 hours as well as the main traditional job. So if we're looking at adding supplemental income, we would generally say we have the full-time job would have to be that we've been on the job for 2 years. And then we have supplemental income or a part-time job that we also demonstrate that we've been on 2 years. So essentially the kind of the takeaway there is if I'm using dual sources of income, I have to demonstrate a 2-year history. If I work solely part-time income has to be validated for 2 years. All right. Okay. And another question was just talking a little bit about investment financing. We don't generally talk too much about investment purchasing, but I'll kind of highlight that really quick. So if you're considering buying an investment property, usually the minimum down payment is going to be 20% of the sales price. Now, with investment property purchases, potentially you can use future rental income to help you qualify. So the rule of thumb is usually a 20% minimum down payment. If you're looking at purchasing, say, a mixed use property, or not necessarily mixed use property, but a multi-unit property is what I meant to say. So when we think about multi-unit properties, 2 to 4 unit properties, the minimum down payment is 5%. If I'm going to occupy one of those units of the properties and then maybe rent out the rest, right? So first-time buyer programs are not going to be compatible with investment properties. First-time buyer programs will work with a primary residence. But if you have some questions specifically about designing or strategic planning for investment properties, let's definitely take that question offline for sure. All right, let's stick with the theme of qualifying income. And I just want to walk you through a quick calculation that we do in lending. It's called debt to income ratio, essentially looking at expenses versus income. So what we're looking at is we're considering what our new housing budget's going to be, the principal and interest, taxes and insurance on my new loan, possibly mortgage insurance, maybe even HOA dues if I'm buying a condo or a townhouse, and then factoring also credit card debt, potentially personal loans, car loans, anything that would generally appear on your credit report. And then we're going to compare that against your gross monthly wages. So if I have $2,500, let's say in housing expense, $500 in other debts, and I'm making $8,500 a month in income, my debt to income ratio, so my expenses versus my income is about 35%, right? So general rule of thumb is we don't want that debt to income ratio to exceed more than 45 to even 50% of my income. So that's on the high side. The optimal level, or I would say kind of the comfort zone for most clients that I teach in our classes, is probably 33 to 36%. Okay, that's generally the comfort zone. But everybody's situation's a little bit different. Obviously, as we go into higher cost of living markets, we tend to see a little bit higher debt to income ratios. But our most important, or kind of our 2 important goals of home ownership for you in our classes is to create sustainable home ownership. So as things change financially for myself, I can still handle my mortgage payment. And of course, make sure that we're creating affordable home buying options for you as well. All right. Now, our last stop in tonight's class before we talk about the buying process in assistance programs is to talk a little bit about our savings for down payment. And as I think about home ownership for our prospective buyers, there's usually 2 challenges to home ownership. It can be around credit, because maybe I've had some legacy items in my credit, or maybe I'm a little overextended, but more often than not, it's just saving up for down payment as well as closing costs. Now, let's first of all talk about how we validate assets for savings for home ownership. Well, we can consider checking and savings accounts, of course, for home ownership. We can even use 401k loans, even brokerage accounts. We're usually going to take a snapshot of the asset activity for the last 60 days. So we really want to avoid cash deposits. Those can't be used. But let's say I just got my tax refund and I want to use that towards my home purchase. It can absolutely be used, because obviously we can paper trail a deposit from the U.S. Treasury in your account. So that can be certainly used towards home ownership. Now, some clients will leverage the resources of family members to help in home ownership. We call that gift funds. There is no seasoning requirement for gift funds. We just have a documentation process that we walk those clients through for those the trailing of the gift funds. So that's what we kind of look at from the documentation of assets. Now, as we prepare for home ownership, I want to just share with our class a little bit of what we call a savings plan for home ownership, because as I mentioned, that can be a challenge for some of us to realize home ownership in a reasonable amount of time. So here's the savings plan I would walk our class through. And so let's say, for example, we're spending $2,000 a month in rent, right? But after meeting with me, we feel like, hey, I think I can budget myself for a $3,500 housing expense. So right now we see ourselves jumping from $2,000 to $3,500 a month in expense, right? Well, maybe I lack the savings to achieve those homeownership goals. So what I would tell our client to do is let's start saving today, like we're making that $3,500 mortgage payment. So every month that I pay my landlord, I pay that $2,000, but I create that discipline for myself that I'm taking that at $1,500 that I have in hopefully additional budget, and I move that to my savings account on a monthly basis. And as I do that, I create that rhythm and that discipline of savings. But by the end of 6 months, I have what, $9,000 accrued to my savings account. Then by the end of 12 months, I have $18,000. And now we have sufficient funds maybe that can help us really achieve our homeownership goals. And so that's kind of a simple approach to saving, but we've had so many success stories with clients utilizing a really simple approach like that that really makes homeownership a much more achievable goal for them. Now, assistance programs can also be a great resource for you on that path towards homeownership. Since we're in California with most of us making our home purchase, we're going to spotlight the CalHFA program, kind of the not only guidelines, but we're going to look at the program matrix for CalHFA. Now, we have the pleasure of being the #1 provider of CalHFA products in the state. So we provide the most number of resources for clients leveraging the CalHFA product. We're going to spend some time talking about today's products that are available. I did have a question in the chat about the CalHFA Dream for All program, and I just want to kind of share with you a little bit about that. The Dream for All program has been in play for our clients the last 2 years. In 2024, it was a lottery-based program. In 2023, it was a first come, first served product. That is a general state fund based program. And the reason I say that is because it's based upon states' general funds. In 2025, we don't have funding for that program at this point. So there's when you do a Google search on Dream for All, there's a little bit of misleading information saying that it's available in April, which is not the case. So unfortunately, Dream for All doesn't look like will be available in 2025. Of course, if something changes, we'll definitely let our classes know. But at this point, Dream for All is not in play. However, there's some really great products with CalHFA that we offer throughout the state. The first program is called MyHome Assistance, which essentially provides up to 3% of your purchase price in assistance for a conventional loan, 3.5% on an FHA loan. So it kind of falls in play with what those minimum down payments look like for both of those products. Essentially what it is, it's a separate loan that we create for you that's only at a 1% simple interest rate loan. And what's nice about that loan is it doesn't have to be paid back on that assistance until you either sell the home or if you refinance in the future. So it's completely deferred. Now, beyond that, for our clients that need additional resources, we have our CalHFA My Access program. Now, this just launched a week ago Monday, which essentially provides an additional 2.5% of your loan amount in assistance that can be used to help reduce down your out-of-pocket expense for your home purchase. Now, that is also at a 1% simple interest rate, deferred payment until we either sell the home or if we refinance in the future. Now, prior to the My Access launching, we had the ZIP Assistance program, which provides 2% of the loan amount assistance. That is a zero down payment option. 0% interest assistance option. But ZIP Assistance can tend to elevate the first mortgage rate pretty significantly. And so that's why My Access was introduced to help alleviate the burden of a higher first mortgage for our clients, but still getting access to some additional resources. So that's kind of a look at the suite of products with CalHFA. Now, we do have some national-based programs like the Pathway DPA program. It works exclusively with the FHA loan. It provides 3.5% to 5% of the loan amount in down payment assistance funds. There's also, you may have heard of the Golden State Finance Authority program, especially if you're in California. That is another alternative option for first-time buyers. What I found is that the CalHFA program tends to be a little bit less expensive than the GSFA product and provides a little bit more of a lift in assistance. Fannie Mae and Freddie Mac also have some programs available nationally that can be a great resource as well too. The programs that we offer through CalHFA are really designed to support low to moderate income households in home ownership. Let me give you a quick example of what a scenario might look like for you leveraging the CalHFA product. So let's say I bought a $450,000 home with a 3% down payment in kind of a traditional fashion without first-time buyer programs, I'm probably going to need about $22,000 to maybe $27,000 in down payment and closing costs funds available to myself, right? Now, for most first-time buyers, that's probably a 3 to 4 year goal in my estimation. But if we looked at adding in the complement of CalHFA My Home Assistance Programs, now we would have that 3% assistance option that could be added in. If we even take advantage of, let's say, the My Access program, now we have up to $24,000 in assistance funds that can help kind of really lower the expectation of out-of-pocket expenses. And now that 3 to 4 year homeownership goal might be a 3 to 4 month homeownership goal. And so that's where CalHFA can be an awesome resource for you in that path towards homeownership. So a question came in the chat. So does that mean you don't have to pay back the deferred payment if you ever sell or refinance the home? So no. So the assistance gets paid back when you sell or refinance the home, but the assistance only accrues a 1% simple interest rate over the time that you hold the assistance. All right, thanks for that question. Now, let me just go through the eligibility really quick with CalHFA. So there are minimum credit score requirements. So on an FHA loan, minimum credit score is 640. On a conventional product, it's 680 for our moderate income buyers, 660 for our low income housing buyers. Now, we learned about debt to income ratio just a few minutes ago, maximum of 45 to 50%. Now, one of the nice things about the CalHFA program is it only looks at income for the applicants, not the household income size or income amounts. So why that's important is because CalHFA uses 150% of the area median income for the income limit calculation, but we only look at the applicant income. So theoretically, I could, if I'm, let's say, I have my partner that has earning income, but combined we exceed the income limits. Theoretically, I can apply by myself and stay within the income limits for qualifying. Now, this is just eligible for first-time buyers, which a first-time buyer is someone that has not owned in the last 3 years. And this product's eligible for any single unit property, essentially, or one unit property, single family homes, condos, townhouses, below market homes that are available to low income housing buyers, as well as manufactured homes built after 1976 that are on like a permanent foundation. And here's the income limits for our greater Southern California market. So depending on where you want to purchase, like if I'm going to purchase in Riverside County, then that income limit applies accordingly. Now, there are other down payment assistance programs that are more kind of localized to our community. One of the programs I've had the pleasure of working with on lately is called the Green Line program. Green Line is an LA County-based program. It allows those that are purchasing with LA County that make less than 120% of the median income to get up to $35,000 in additional assistance. We'll send you some information on that as a follow-up, but if you're thinking about buying in LA County, another great program that can be used in complementary with, say, some of the CalHFA products. So we have a client buying currently a condo in LA that's not only maximizing the 3% My Home Assistance program, but also taking advantage of the $35,000 Green Line program. Green Line is a grant program, so that's a really great feature. It does have some prerequisites to it as well as some restrictions, but really great program that can help complement home ownership for you as well. All right, I know we're coming up right against the hour, but before class adjourns, I do want to walk you through the buying process really quickly because I think it's really important to understand. I've learned all these, kind of interesting topics or hopefully informative topics tonight. Like, where do I go from here? So let's talk a little bit about our 6 steps of home buying. And after you leave tonight's class, you'll have the opportunity to get connected with me for a consultation to help design your home buying plan for you. Now, the output of a consultation with us, and by the way, that's a free service we provide to you. But the output of that consultation is to have you pre-approved right now. And that pre-approval is generally good for a 60-day period of time, but there's no really time crunch to go out and buy a house right away. Your application with us stays live for 2 years, but we wanted to kind of create a baseline for you in eligibility. In creating that pre-approval, that gives you the ability to really understand what am I eligible for, and if I decide to start that home search, which would be the next milestone, I could present confidently an offer to a seller and let them know my financing is all in place. And that's step 2, which is the house hunting phase. So at that point, we're looking maybe from online to maybe in person at a particular home that piques our interest. we would encourage you to connect with a realtor in your local community. Across California, we have a preferred realtor network of trusted realtors that we work with that really kind of specialize, especially with first-time buyers that we trust in creating a really great client experience. So that's step two, is the house hunting phase. Now, let's say I find a property that I really like and I want to make an offer on that home. Now, you would take that pre-approval in partnership with your realtor and present that offer to the seller. Now, if the seller accepts your offer, then now that activates the entering escrow phase of the process, which moves us to step three. So now we have an agreement between myself, the buyer, and the seller, and it really starts the process. Now, to go from accepted offer to when I get the keys to my house, traditionally it's usually 30 days. But in our process, it can be as short as 14 days, depending on how aggressive of a timeline you're looking to make in your prospective offer to the seller. Now, at step three, once you have an accepted offer, you're going to get a call from me saying, congratulations, you now have an accepted offer. Let's talk a little bit about next steps, and then we'll schedule you for a follow-up video session where essentially we kind of go over the redesign work of your financing, update your market interest rate, making sure that your assistance program is in place, all of the kind of the important details that you'll need as we kind of continue on in the process. Now, as a buyer, there are action items that you're going to be taking as well, including making your earnest money deposit for your home purchase, which essentially is a good faith investment in this purchase, indicating the seller that you have a financial interest in making this transaction fulfilled, right? The earnest money deposit is usually 1% to 2% of that sales price and counts towards your total out-of-pocket expense for your home purchase. Now, in contracts within California, the real estate contract has what we call as contingency timelines for your home purchase. That allows you to get your appraisal done to make sure that your appraised value supports the purchase price of the home. You get your inspections done to make sure there's no issues potentially with your home. And then finally, get your loan approved, right? So us as your lender will get the loan approved to ensure the financing is in place. That contingency period usually runs within the first 14 to 17 days of the contract period. Why it's important is because it essentially protects your deposit, that while you go through the due diligence of your home purchase, you can feel safe essentially that you're not going to lose your deposit while you do your background work. Now, as we move through the process, we're going to be doing the processing of your loan and fulfilling the underwriting of your loan at step four. We'll also be looking to strategically lock in your interest rate because interest rates change every day. And so our goal in guiding you through homeownership is to try to take advantage of kind of these ebbs and flows in the market and hopefully secure the lowest option for you in terms of interest rate. Step five is going to be the loan approval phase. That means the underwriter has issued the loan approval. We also probably have your appraisal back by that time. Also, your inspections have been returned in partnership with your realtor. Also gets us about 75% of the way through the process. At that point, we're going to be issuing you a final closing disclosure, which essentially gives you a 3-day cooling off period before we get to the final milestone. Now, that closing disclosure is in e-signature form. In fact, all of our disclosures throughout the process are all e-signature items. But as we move into the final stage of closing your loan, those documents are done in person with what we call as a public notary. And that closing of the loan phase is really kind of at the finish line, right? The signing of your final loan documents usually takes about an hour, maybe to hour and a half, depending on how many documents are there for signature. At that time, you also will be wiring or providing a cashier's check for your final funds that are owed in the transaction. Those monies get reconciled by the escrow team. They also take into consideration the funds that you're getting from your financing. The monies get balanced, so the seller's receiving the benefit or the proceeds that they're receiving as part of the sale. You're also contributing what you're supposed to as a buyer. And after that gets completed, then documents get recorded with the county recorder's office. They record a grant deed that transfers ownership to you, as well as the deed for the mortgage for your repayment schedule. And after all those confirmations get done and recording, then I get a chance to make my favorite call of the day, which is to say, hey, congratulations, you're now a homeowner. And that's my favorite part of the day. I get to do that usually a couple times a day. And it's just a celebration of a huge accomplishment because let's face it, this is probably one of the biggest financial goals that you're going to achieve in your lifetime. And to say that you're a homeowner is truly one of the biggest American dreams out there, right? In fact, we have UC Riverside alumni actively in processing right now. They're in escrow going through this exact process as we speak. Now, our relationship with our clients doesn't stop there. So even after you get the keys to your home, we want to be a partner with you in taking advantage of refinance opportunities, updating you on the market. We always do annual reviews with all of our clients to make sure they're in the best possible position financially. And if a refinance opportunity presents itself, we want to help seize the opportunity for you. All right. Well, as we're wrapping up class, I just want to share with you, how do you get started in the process? Where do we go from here after tonight's class? Well, I'd love to connect with you for a consultation to help design your own home buying plan. Whether you're going to buy in 2025 or 26 or beyond, we want to be a partner with you on that path towards home ownership. It is a free service we provide, and we have a very simple 3-step process outlined here. It's an online application, which includes a soft credit check that doesn't impact your score. You upload documents, and then you schedule your consultation using our scheduling system. So really simple way of learning more about homeownership and your goals for achieving it. Now, if you have some questions after tonight's class and want to just ask a question that didn't get answered tonight, or maybe you want to go through a scenario with us, we'd encourage you to use our scheduling system to schedule an introductory call. All right, now here's what our consultation looks like. We talked a little bit about it, but again, it is a free service of designing, what your options look like for budget, understanding more about your credit, where do you want to buy. Let's figure out if some of these assistance programs might work well for you, walk you through kind of how the buying process is going to be applicable for you, and just get a comprehensive plan for you. And if you're ready to be pre-approved, we'll activate that as part of that consultation. I also want to spotlight one of our really cool resources, which is on mobile. You can start the process right there, but you can also follow the progress of your loan. Also use the calculator feature, especially if I'm at an open house on a Saturday and I want to know what that $450,000 payment might be. You could do that all via mobile. Well, I shared this with you earlier, but as part of our UCR alumni partnership, we not only offer our free classes 4 times a year, but we also provide discount in our services for both a home purchase and a refinance. So I kind of spotlighted those for you there. We also have a pretty broad network of alumni partnerships that we support all across the country. And we teach classes like this all throughout the year. So we have on tap over 50 classes available in our local communities. So if you have friends, family, maybe coworkers that you think might really enjoy some of this content, we'd encourage you to share some of this information. You can find all of our upcoming classes by visiting us at mortgageeducate.com. And I've also included our link again for our scheduling system if you'd like to check that out. We're really passionate about serving our home communities and home ownership, and we like to celebrate what's happening in the marketplace and share some of the experiences of our clients on our social channels. So we'd encourage you to check out kind of what people are saying about on our socials. We'll also have this class, like I mentioned, recorded and up on our YouTube channel tomorrow. All right. So I got us there. I'm a little bit over schedule, but I know we wove in some questions tonight. I want to make sure, any other questions from our class tonight? You guys have been a great group, and I appreciate you hanging in there with me. I did have a question came in, I think in the Q&A. So for the rest of the group, in case you know, this question came in: how long do we have to wait to set up a consultation after this workshop? You can book a consultation as soon as you want. I think we do even have spots available in tomorrow's calendar. So it's really up to you. We're completely flexible, but our scheduling system shows all of our availability over the course of the year. So, and again, that is a one-on-one with me. So I meet with all of our clients that we interact with through our workshop platform. So I want to make sure that I help personally guide you on that path towards home ownership. All right. Any questions? Anything else that let me see, make sure I'm not missing anything there. Okay, one question was, would you guys be able to help with new build homes such as townhomes? I know they usually require you to go through a preferred lender. So yes, we absolutely do resell homes and new construction. New home builders will encourage you to use their in-house lenders. Sometimes they offer incentives for that, but there can be a trade-off in utilizing preferred lenders. It may not be the most necessarily competitive option, but you more than likely will not reap the benefits, especially of assistance programs. If you're interested in that, usually they're not either approved for assistance programs or don't have the capability for that. And then Another question was, are these services available for building a home? Like that sounds like construction question. So if you're trying to build a home, construction financing is something that can be a little bit challenging. With construction financing, you have to first acquire the land and then get financing to build. We do have a construction product coming out this year. That I think the kind of the part of the formula that we'll have to figure out is acquiring the land. But we can probably talk a little bit more about that offline as well too. And then another question was, do we do the Section 184 loan? We do offer that program. It's a component of the FHA loan product. So as part of your consultation, if that's something you're interested in, we can certainly talk through that a little bit. I do have one of my colleagues that specializes in the product that I would probably introduce you to, because that is a product that we want to make sure you have all the resources to. Okay. All right. Good deal. And Ken, thanks for chiming in on that. I appreciate that. All right. And everybody's hanging in there too for all the questions. I really appreciate that. I know we're a few minutes past the hour. So any other questions from our group? Okay. Awesome. All right. Well, it was a pleasure having you in class this evening. Thank you so much for your time this evening. I do hope I get a chance to connect with each of you to build your own home buying plan and really be a partner for you on that path towards homeownership. Have a wonderful night. I'll look forward to connecting with you soon. Good night.